This week saw the release of the March quarter national accounts in Australia, the first comprehensive measure of economic activity in 2025. And what it shows is the economic activity is still working through this consumer-led stagnation. GDP barely rose 0.1% in the quarter, avoiding that dreaded negative that can often lead to the recession tag, but lagging a long way behind population growth. Over the quarter, about 0.5%, over the year 2.4%. Annual GDP growth was just 1.1%. There were a few surprises in the detail. Consumers did manage to spend in the quarter, partly relating to the Taylor Swift concerts and Formula One events around the country. Overall, spending rose 0.4% in the quarter, which was a little bit better than expected. The ABS also significantly revised up its previous estimates of spending relating to Australian tourism spending abroad. Those changes have softened some of the weakness that we've seen over the last couple of years. The cumulative change is about 22 billion higher now. That's softened some of the stagnation that we've seen through the consumer sector, but it's still a very soft picture around the consumer. Per capita spending declining on a par with the declines we saw in the early 90s and early 80s recessions. Outside of the consumer space, we saw some negatives around dwelling investment and business investment, both down about 0.5% to 0.7% for business investment. The latter looks to be a temporary effect, though, that we expect to wash out in coming quarters. Public demand provided some offset. We saw a solid rise across government spending that countered some of the weakness elsewhere and kept growth above the zero line in aggregate. Our net export contribution was a big drag this quarter. That was a story about a strong rise in imports, though, which looked to be catching up on demand from previous quarters. So it does look to be transitory. The picture of this stagnation, 1.1% growth through the year, sort of compares to par for Australia in the 2 to 2.5% range. And as I said, it's lagging population growth significantly at the moment. Looking ahead, there does look to be a decent prospect of improvements when we see household incomes, for example. We are starting to see positive growth in annual terms. In disposable after tax, after interest and after inflation terms, we're up about 0.4%. Some of that drag is dropping out of the picture. But coming back to that revision around consumption, one of the byproducts of that change is now it looks like households in aggregate have been setting much smaller amounts aside for spending. They've been drawing on their pandemic savings more heavily over the last year to fund that spending. Savings across the household sector in general is virtually zero over the last year. They've been drawing on those previous funds. That reserve now looks to have run down more materially, probably in the order of about half of that $260 billion reserve now looks to have been depleted. And that brings forward the point at which consumers will need to start spending more in line with incomes and go back to accumulating or not running down their savings at quite the same pace, maybe a slower growth profile off the back of that. But against that, we will have additional supports coming from policy, tax cuts in July, additional cost of living measures, some continued easing in inflation, and some continued improvement in the wider economy over the next year or so. The other key points of interest here that the RBA would have been interested in are some of the components of the national accounts which relate to domestic inflationary pressures, in particular productivity growth and unit labour costs. Both showed some improvement in the quarter. Productivity growth now about flat on a year ago, and unit labour cost inflation is moderating, broadly in line with expectations, so possibly giving the RBA a little bit of comfort. So the main takeaways here: growth is still very subdued. Demand across the wider economy remains soft. The consumer looks a little bit better in terms of their performance over the last couple of years, but is still very weak. And their reserves are more depleted, meaning they may be more constrained going forward. For the RBA, it's probably a bit of a wash in terms of their expectations, with that improvement around inflation domestically probably the thing that they'll be most interested in. A very interesting week for the economy.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording. and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.